It's Friday. Hi, I'm Keith Fitz-Gerald. Welcome to today's 5 with Fitz. Thank you so very much for joining me. Let's make it a great week and a great finish to a great week. All right, here's today's thought, the dominant thought. Profits don't wait for the unprepared, so be prepared. A quick look at my charts today tells me that all three major indices or averages could close out the week and the month in the green. Now, I know they're all red as I type, but that doesn't change the proverbial score. It's innovation 1, naysayers nothing. Again, the S&P 500 has returned 16.60% since April lows, while many stocks we talk about regularly have done considerably better. Which is, of course, why we talk about them, but I digress. The thing I want to drive into your head, just like it was driven into mine years ago, is that the markets reward knowledge, not guesswork. So don't guess, take advantage of the facts, stick to your playbook. And here's mine today. Number 1, tariff tantrums are us again. U.S. President Donald Trump has let loose with commentary that China is cheating, and all three averages are predictably down again as I record this in early going on related news that a federal appeals court has temporarily paused a lower court ruling that blocked reciprocal tariffs. Now, neither of these things surprises me, and don't let the noise rattle you. If you're investing in terms of days, you're going to get this. If you're investing for months, you're going to get this. But if you're investing for decades with that perspective, you're going to get that. That's how innovation works. It has never in the history of recorded humanity ever failed to produce growth and profits. Number 2, earnings are a whole lot better than expected. Also, again. Now, I know I sound like a broken record, but here we go. This is critically important for every investor, and you want to pay attention if you're as serious about your money as I am. According to FactSet, and as of last week, the S&P 500 has reported earnings growth on average of 12.9%. That's pretty darn good, folks. 78% of S&P 500 companies have beaten EPS earnings. Now, I know the headlines make it seem like everybody's going crazy and the sky is falling, but only 8 companies as of last Friday have withdrawn estimates or are not updating for fiscal year 2025. So, yeah, things are clearly not as bad or as rough as the headlines seem to imply every morning. Remember how the game is played. News agencies could give a rat's patootie about whether you make money or not. They make a good chunk of change, their money, by constantly cycling hype-driven, sensationalist-loaded stories because they want to and get paid for attracting your eyeballs. Now, the sooner you learn to stay focused on great companies putting up great numbers, the sooner your portfolio can thank you. Speaking of which, number 3, Costco nails it. Costco just dropped earnings, and as expected, the company hit the ball out of the proverbial park yet again, one more time. $63.21 billion in revenue, 4.28 in EPS, both ahead of expectations. Same-store sales, plus 8%. E-commerce, nearly 16% to the upside. Membership fee income, plus 10.4%. Costco's advantage isn't just bulk goods and cheap gas like people think. It's structural, and that's a point that most folks simply cannot be bothered to understand, but an advantage for those who do. Here's why. While other retailers scramble to pass on rising costs, Costco flexes its size. Fewer SKUs, tighter supply relationships, and massive purchase volumes means it negotiates better pricing and is capable of eating margin when it makes strategic sense to do so. Now, it's one of the precious few retail stocks that could benefit from tariffs, an argument I advanced at the very beginning when those things hit and which caused more than a few folks to scoff in my face. Now, I hope you own shares because heck knows we've been talking about them enough. And if you're an OBAer following along with our research and own those shares, well done for doing so. Costco has returned 140.38% since I brought them to your attention versus the S&P 500, which has chalked up a mighty respectable but far less 33.26% over the same time frame. If you're doing the math, and I suspect you might be, that's a 4.24x performance advantage, and not for nothing, one that I see continuing for all the reasons I'll lay out in June OBA, which I'll get to in a moment. Meanwhile, here's a bit of investing wisdom that might help at a moment like this. People want to make investing complicated, but it's not rocket science, folks. You buy the best, ignore the rest. And you're not sure what's the best? You're not alone. And guess what? You might find one bar ahead helpful. People tell me it's changed their lives, and I'll be here if you need me. Now, Number 4 today. This one really is intriguing. It's the one data point that makes me want to pull on something else that I can't get my hands on. So we'll just have to draw some inference here. But summer rentals are apparently down 30% in the Hamptons. Okay, so hang with me on this. This is going to be a connect the dots first. CNBC is reporting that summer rentals in the Hamptons, which is where all the New Yorkers and the highfalutin hedge fund managers and all those folks go in the summer, are down 30% this season. Now, brokers who focus on the ultra high-end rentals and are apparently saying that their business has been hit even harder with a drop of 50 to 75%. Now, before you and I break out the tiny violins, the question I want to know and the data point I want to see is what are Costco and Walmart sales doing out in that area? That's the real tell here. If they're rising, and I suspect they might be, it's not a death knell. In fact, it's just a shift in spending and powerful confirmation that what we've been talking about is spot on. Fewer beach mansions, more bulk buys, and budget-conscious backyard barbecues. Bottom line is, if luxury's down, that equals a discretionary pullback. But if luxury's down and warehouses are up, that equals middle market strength. And I'm betting that we've got plenty of the latter. So, Keith's investing tip in this arena is super simple. You follow the carts and the cash, not the odds. As an aside, back in the day, we used to count empty parking lot spaces back when we wanted to know how retailers and real estate developers were doing ahead of critical earnings reports or other big meetings. Now, I wore out quite a few pairs of shoes, and stock to buy would have been sunscreen and taco trucks. But that's a story for another time from another era. I had hair back then too, come to think of it. Anyway, long story short, it's issue Friday. I'm very excited. If you're an OBAer, please keep an eye on your email. The June issue drops later today after the team and I put a few finishing touches on our latest research, which I might add took us in a very exciting new direction with a recommendation that might catch you by surprise. I think you're going to like it as much as I do. We've also got a deeper look at quantum computing this month, along with a cheat sheet that'll come in handy at the next neighborhood barbecue or get-together or simply around the dinner table. The portfolio review, of course, is chock full of breaking news and updated thinking. I am more confident than ever, speaking of which, that we're in the right place at the right time. And the numbers support that, by the way. I'll also be sharing exciting new research on resetting our biological clocks, something I'm keenly interested in. Why? Because it's all in the name of bigger, more consistent profit potential naturally. You know, a strong body plus a strong mind equals strong results, or at least that's my take on it. Now, if you're already confident in your strategy and you're seeing results you love, that's cool, that's fantastic. But most investors are throwing darts at the wall and lack any sort of comprehensive strategy, which is why, dare I say it, they're falling behind. Wall Street, of course, talks a good game, but honestly, today's markets have changed, which means a different approach if you want different results. If you don't and you're content with table scraps, that's okay too. Plenty of people are. It's your money and it's entirely your call. On the other hand, if you'd like to up your game like other like-minded investors have, I'd like to toss my hat in the ring. There's no pressure and there never will be. Today's bottom line, there are two ways to play the game. One, you can get in before the crowd, which tends to equal bigger returns. You can control risk ahead of time, which equals less stress. And you can build confidence, which means you get to hold strong when others panic. Or, second approach, you can wait and react, in which case you lose. Now, I know which approach I prefer. Do you? As always, let's make it a great day and finish the week strong. I hope you've got something fun planned this weekend like we do. You got this, I promise. Thanks for watching. See you Monday.